All right, so this is just the second meeting of 2019. It might not be as relevant for people watching in the future, but it actually could be because I want to touch on tomorrow's Fed meeting and some stuff that you should know and be prepared for. Uh, Generally, when we did our previews, it was a couple hours before the event. We'd have a meeting in the lunchroom, like around 11 o'clock for a one. Back then, they were released at like, it was weird. It would be released at 1:12, 1:17, one. It wasn't an exact time. So about 10 years ago, they timed it to the statement to be released exactly at 1 Central. So that's going to be the release of this statement. Could be an impactful one. But we would meet about an hour, 2 hours really before, when the analysts would go over anything that's relevant. And so, and we'd have some Q&A and he'd go through some stuff. So I wanted to spend the beginning. This isn't Einstein stuff, but it's important to underscore, to listen to, and get a sense of if stuff's important. To hear it again and again doesn't hurt. I didn't have time to type it up on a slide, so I kind of write it. First of all, they're not going to do anything with interest rates. Oh, that's a terrible color. Let's go to yellow. So they're not going to raise interest rates. No, that's one thing they're not going to do at this meeting. We know that. That's baked in. They want to see the statement change. When I say they want, the bulls in the stock market want to see the statement change to patience. I'm not going to write the word patience and data dependence. They want to see those phrases inserted into the statement. They also, and we touched on this Friday, and we'll see if Powell talks about it, but Friday, if you remember, we woke up and we had a gap open higher. Some of it was due to the smart money knowing that the shutdown was going to end later that day. And the other was the Fed slowing their balance sheet reduction. So if their balance sheet, let's just say, looks like this, right? This is zero, and their balance sheet is up to here. They're trying to reduce it. If they're trying to reduce it to zero, instead of going down there fast, they're maybe going to go down slow, that reduction, which the market liked. And on Friday, we had a gap open higher, much to do with that balance sheet comment. So you're going to have to pay attention to the statement and then Powell's press conference, which comes at 1:30 Central. Now, something's changed. Every Fed meeting is going to have a press conference a half an hour after they release the statement. It used to be every other Fed meeting. Years ago, Fed meetings were just Tuesdays. Then they made some of them Tuesday, Wednesday, and then during the financial crisis, they made every Fed meeting 2 days. Tuesday, they commence. Tomorrow, on Wednesdays, they release their statement at 1 Central, and then the press conference. Every meeting now is going to be at 1:30, and there could be Q&A that moves us, although most of the volatility comes on a statement that might have any outliers. I want you to remember this word because this word it affects anything that drives the market, not just Fed statements. Is this thing recording? Yeah. So outliers. What are the outliers to this meeting? It would be if he didn't sound dovish and he kept some of the stuff like roughly balanced in the statement. And so if he wasn't as dovish, I'll use the word less dovish. Less dovish. If he's less dovish, that's makes sense to say more hawkish. And if he's more hawkish than the market wants, it's look out below in stocks. I have to say this, even though so many of you heard this many times, but stocks and bonds move together when it's central bank headlines. I'll say why, because if interest rates go up unexpectedly, stocks go down because money's more expensive if it's unexpected. Bonds have to go down to price in higher yields. Do you want to hear this? Listen.
This announcement is to inform you that schools will be closed in Naperville 203 tomorrow, Wednesday.
See if they do it in Spanish too. Just interject a little humor. They keep calling, leaving messages. All right. Buyers, sellers, or not buyers, sellers. Stocks, bonds would go down if interest rates go up unexpectedly. Not go up unexpectedly, but there's more hawkish tone. Bond prices have to go down to incorporate higher price and higher yields. That's how bonds work. We could have a whole nother session as to why, but bond prices go down when yields go up in that instrument. So getting back to point I'm trying to make is if interest rates are hawkish, or if the statement's hawkish, which is higher rates, bonds will go down to price it in, stocks will go down because it's more expensive money. They don't like it. So stocks and bonds move together knee jerk when their central bank, whether it's European Central Bank or our Fed. Keep that in mind as you head to watching those relationships after the statement tomorrow at 1. So just to recap, 1 is the statement, 1:30 is the press conference. Both could have impact. Getting back to the preview, though, there was another thing I read that they're going to move to economic conditions, EC, economic conditions could go from strong, which is the word they've been using, and then they've kind of pulled back on that word strong, to solid or firm. Why do I say solid or firm? Because that's what they said the terms might turn into. So there's been some diminished economic growth optimism late last quarter or in the fourth quarter last year, which is bearish for stocks, but then it's bullish because the Fed could just take it easy. And as you know, the president has been on the Fed for raising rates too far, too fast. But I don't think the Fed wants to seem like they're capitulating to the president because they're supposed to be independent. They're trying to find a way maybe to not raise them as fast. They're not on that every other Fed meeting pace to raise rates like they were in 2018. Every Fed meeting, they went up a quarter point. They're not on pace to do that. So the stock market, bond market, they want to see in the statement that they want to kick the rate hikes down to late 19, if anything. All right. That's kind of what they want in this statement. Anything else would be bearish for stocks and bonds. So they replace the word strong with solid or firm, would actually be bullish for stocks. Instead of the phrase, I'm not going to write this down, but some further gradual increases, change it with the word patience. They want to see that word used. That would be bullish for stocks. Patience, if that word is used in tomorrow's statement. Then, like I said, balance sheet reduction. Slow the balance sheet reduction down so it doesn't, that's what created some of the bullishness last Friday. For those watching this in the future, this is January 29th, and tomorrow, the 30th, it's an FOMC meeting. It's important then to go back and look what the meeting did, what the statement was, and how the markets reacted. So this is a typical kind of meeting that we would have in a prop firm that he'd go over, and then we kind of ask some questions if people had questions, but just walk us into what the markets were doing, what they were thinking the statement was going to be, and then don't forget this word. I'm going to say it again. Use this word a lot when you're talking about drivers, not just the Fed. Outliers. Outliers is wasn't expected, come. That's why they call a surprise, right? Nobody expected it. A lot of money to be made in surprises when you're privy to something the market wasn't even either expecting, and boom, they got a pricing in. So the reason a surprise is because no one expected it. Get better this year at diligently reacting to headlines that cross. Initially, the question is bond and stock futures, stock indexes and bonds will move in the same direction initially. I can't promise how long that stays intact. And they move faster, further, if there's an outlier or a surprise in the statement. The statement isn't as dovish as it probably is going to be. If it seems a little hawkish, both prices will initially go down. They start using words and he starts talking about balance sheet reduction, slowing that pace, use the word patience, then you could see some bullishness, especially initially in the reaction. So that's not necessarily the best Fed preview you're going to get, but it's a preview, and I encourage you to go online and read up on some other stuff, staying focused on what's expected, then you know what's not, right? If you know what's expected, then you could determine what's not expected. You'll be, trust me, everybody in here is so far ahead of everyone else that doesn't do some of these short previews. It's ridiculous. So that's the front part of this meeting. And remember, for the guys that are newer, just keep in mind these meetings are just get-togethers every Tuesday. As if you worked in an office, we kind of meet in the conference room and go over some stuff. But let's get on with a slide. I'm not going to take it as long as last week, but I want to stay on this heat map. And one other thing, we're going to have later next month, Peter Davies come in from Jigsaw. So if you guys are interested in some of the stuff Jigsaw has, questions for him, some of his different tools. Some of them are heat map related, right? Some of them is day trader. He'd talk more about that. Good guy, and I think he'll be an interesting guest host in a month for one of these sessions. But it's definitely February. I can't think of the date, but it's, I think, the last Tuesday session in February. Then we'll also have Brett back and some others. Kepler, if you'd like. I just take kind of unofficial surveys late last year, and some of those guys are coming back. But I'm staying on this heat map because it's a better way to see the same thing. And if you got something similar to it, great. Not everybody has to use it. But it's doing a great job identifying passive buyers and sellers. And it's been around a while, but I think the explanation of how to use it is better through us and through here. We talked last week about why it's a magnet, because buyers have to go where sellers are, or sellers have to go where buyers are, right? Some of the examples or analogies I used was, if you're a seller of artwork, good chance you go to an auction, you'll find buyers there, right? You're a seller, you go to an auction house and you'll find buyers there. If you're a buyer of a car, where do you got to go? Maybe some car dealerships, somewhere where they're selling cars, right? But there's also another reason why they're magnets, and stay with me on this. So let me turn this guy down. Is there any questions on the Fed before I move forward? No? Okay, good. So let's pretend like we do, in fact, have a big seller, and it's a house. Big house, not just physically a big house, but it's a big house, and it's a big sell order. And I'm just using a house for an example, but it's a big sell order. I should actually just use a big number instead of a house, but let's just leave the house in there, okay? When you get a big seller in the book, initially, and you would get this all the time in the pit, you would get people, I covered this in a long time ago edge session, but it's good to go over again. You would get people that would lean on a big sell order. They're going to lean on this big order. Well, it's a sell order, right? So when you're leaning on a sell order, that means you have somewhere to go if you're a buyer. If you're a buyer, you have somewhere to go. You could get into this order because it's a big, giant order, correct? What people do often initially is they actually will open up short positions underneath the big sell order. Let's examine that dynamic. This guy represents a sell order. He's short. Now he's a buyer. This guy gets short, turns him into a buyer. This guy gets short, turns him into a buyer. This guy gets short, turns him into the buyer. Remember, after you sell it to get short, you're a buyer. So all of these guys, they're not sellers anymore. They're shorts and they're no longer around. They turn to buyers, right? After you get short, you're a buyer to cover it. Why did you get short? Because you're leaning on a big seller. This guy up in here happens to be a house. You're leaning on it. Well, at some point, when price comes up, you get the dynamic of people opening up shorts because they got somewhere to go if they're wrong, correct? They could buy into this big sell order. So the price goes up, and maybe I'll come off and use it as resistance. But it'll often attack it a couple more times using this price of where a big sell order came in as a magnet because of the dynamic that's being created of the shorts that are being put on because of the order. It's like a self-fulfilling prophecy. These guys in here, let's go the other way. These guys in here would have never opened up a short position had it not been for the big sell order. But because they opened up a sell position, a short position, not a sell position, short position, it creating the buyers below. That's what all these guys in green suits represent. Shorts that now are buyers. Why'd they get short? Because they're leaning on this seller. What happens when that seller goes away? They're all rushing to get out. And in some instances, the reason why it goes away is because these guys will start coming up nibbling on it. And nibbling on it. You could actually say it's like a physical wall that's standing erect. You keep pushing on it, pushing on it, pushing on it, and all of a sudden it falls down and it's laying on its side. When you lean on it, too many people are leaning on it, it falls over. Make sense? The point is if this sell order, back in the days of the pit even, when a big sell order came in, guys started getting short underneath it. Well, some of the guys, they'll make money because the market went down, but because they accumulated so many shorts, they accumulated so much buying. Because you accumulate so much buying, the market went up to a place that it was the reason why it became a buyer in the first place. Does that make sense? The buyers became buyers because this order existed. So generally, when a market is leaning on a price, it's going to take it out. It's another reason why the market's price always goes to the orders. Talked about last week in that example. Watch that video of last Tuesday. And now this week, it's people who get short underneath a big order turn into buyers because you guys know after you get short, you're a buyer. Enough buyers are created to lean on that big sell order. They chip away and then they release. And especially if that sell order is, I don't want to say it gets pulled. It could get pulled and you'd see this run up, but maybe it just gets chipped away, boom, and then you get the release. Let me read a couple questions. In other words, if the order is pulled, it could trigger the buyers. Exactly. Or I preemptively answered your question. Exactly right. That's one way it could, orders pulled and it could create that pressure release. The shorts start here. Someone's recapping what I said. This is perfect. The shorts start very near the big sell order. Then, because when you get short, you turn into buyers, right? You turn into a buyer. If there's enough buyers, chances are price is going to go up. Think of it that way. People are getting short, leaning on the sell order. Getting short, leaning on the sell order. Now, today's example, I'm just talking about a sell order. Just flip things around for buy order. But let's just focus on a sell order. They're getting short because they're leaning on a big sell order. If that big sell order wasn't there, Ron, there wouldn't be as many shorts underneath it. Therefore, there wouldn't be these buyers that are created from shorts that get opened. Most people never think of that, Kurt. That's the thing about the most valuable thing. If someone were to say to me, what do you think the most valuable thing you've ever taught people? And that is, after you sell it, you're a buyer. And all the kind of details and techniques that go underneath that. After you sell it to get short, you're a buyer. After you buy it to get long, you're a seller. So let's go to not to that. Let's go to a screen. Heat map. When you see a new order come in, especially initially, what generally happens is price reacts lower. And it's because people are getting short underneath that order. Then it becomes a magnet. They either take it out or the order gets pulled. One reason why it could be resistance is because people are getting short underneath it, Ron. But eventually the buying, because of those shorts, take it back up through it. You could see the brightest color was 44 quarter, pretty much. That's where it went, stopped, comes off. It's a magnet, like we talked about last week, and it becomes short-term at least resistance because of what we're kind of talking about this week. But it's also helpful when a new sell order comes in. Like might have been the case in here, but you got to replay your Sierra where this order comes in, they get short underneath it, gets pulled. It seemed like got pulled and they were able to release above it. This sequence right in here. It's a way to follow, one way, the visual to follow big orders. The heat map has created a great visual than just looking at a dome. And what it's really helped, I think, people, what it will help people is the fact that you guys could cut a lot of experience you need with several months and years of screen time with better visuals and better audio. Alessandro, I'm using a couple pieces. I'm using Market Delta, but also Sierra. This is Sierra because they have a nice heat map version. They have a heat map. Yeah, but Ron, you're in the minority, right? You got more people buying than you are selling it. So don't overthink it and just practice using it as, hey, this is calling direction, and then work on your location. And you don't want to be perfect either. Exactly. So this goes for any target or any strategy you guys have. Anytime you have a target to get out of a long, remove a few ticks and go below it. If you have a great target at 44 quarter, offer it at 30, or I'm sorry, offer it 43.75, 43 half. Especially give it some room not to be perfect, especially if you're in the trade for 4 or 5 points. A few ticks doesn't matter. But it does matter if you don't get filled and it comes kind of close back to your entry. Don't try to be perfect with your target. Especially, like I said, the bigger winners you have to get out of, the more lenient you should be with where the hell you get out. Don't try to be perfect. On Sierra, Mark, Mark asks, has anyone figured out a mark absorption on the footprint of buyers and sellers? I haven't tried. If anybody has, pop it in here. A couple things I'm working on with this to make it easier to understand, but I'll leave you in suspense. It's I think it'll be pretty neat of using this in a more visual way for us. Sights and sounds. So we get a pretty good sell-off right now, right? And you look and you say, could you have predicted this? I don't know. I've not been watching. I think that you always go back, and in hindsight, things are easier, but try to figure out where there could have been a tipping point of, could I have recognized when this green gets taken out and a big buyer comes in and gets smashed right in here, that the downside's the right side? They're just rushing through it after a nice rally. You know what I mean? If you're not, I was kind of discouraged when I asked people who replays a few times a week. Not a lot of people do. And it's like, if you're trying to get better, you're not going over the video. You know, it's like the NFL, these professional football players, that's all they do is watch tape, is part of it, unless they're actually on the field going over drills. You got to watch tape. I can't force you to do it, but try to watch tape to predict what's going to happen next. That's what these professional athletes are doing. They're watching tape saying, hey, they got their defense lined up this way, so they should stay in that formation. Let's see if they do. Just picking up clues. Hey, a big passive buyer came in and they started moving through this aggressive buying over here. They should go down, and then they do. Then you get confident because it's less randomness. You don't have to go crazy and spend hours and hours. Let's just be efficient with it. You don't have the luxury of meeting always with people after each session like I did in a prop firm, and we could kind of replay the day with each other, right? You don't have the luxury necessarily to do that. But I didn't have the luxury of replaying the day on charts either. I have that plan, John. We'll do a session on how to do the replay. I've got that on the list. But it's pretty easy, and some ways to use it and practice it efficiently. Any other questions? Remember the lean. I did a topic like this a couple years ago in the beginning, and now I think there's a better way to see it. I'm really getting into not just the visual, but the audio of stuff, and not just the verbal journal, but the addition to what we don't use is where our advantages are, right? What could we use that others aren't using? That's always an edge. So I'll leave you guys with with this. If you're walking through a jungle and you're hunting, what are you depending on? You're depending on your eyes. You're depending on your gun, but you're depending on your eyes and your ears. If you don't have both, you're at a bit of a disadvantage. But you can't have these robotic sounds either. It's not natural. Kurt, do you have Sierra? Here's the settings for this. I'll leave these settings up. If you copy these settings, just write these down, then the chart will look like this chart. Hey, just in some real-time analysis, this selling midday came out of nowhere, so these retracements are shallow. Shouldn't surprise you. But just to recap today's session, Fed tomorrow preview. Watch this video again if you have to, but make sure you Google some previews of the Fed, 1 Central, and then another reason why today's session that big orders are magnets, and why the guy 20 years ago said the market always goes to the orders. He didn't explain it as well as I have, but he turned me on to it. Well, 20 years ago, it was probably 18. It was in the first few months of me starting. You got it? Good. All right, guys. Exactly, Stan. Oh, I almost forgot. Thanks, Bruce. Thank you. And this won't be relevant for people watching in the future, but for you guys. Apple's earnings today after the close. All kinds of earnings coming out. Was it Bank of America tomorrow? Amazon Thursday. GE Thursday. Exxon Friday. Apple today. If you have nothing better to do, and most of you don't, because I know most of you guys, sit at your computer 3:30 Central. Apple's the NASDAQ stock. So it's going to affect the NASDAQ. They go up or down together. Sometimes there's a lead lag between the NASDAQ and the ES. So Apple will have better than, let's say, expected earnings. Boom, NASDAQ and Apple fly up and you could buy the ES. Any other questions, guys? I'm going to stop the recording.